Well, hello everyone, and welcome to the webinar. My name is John Bowens with Equity Trust Company. Really excited about today's very unique program, very much more unique than any other webinar this year. And that is because this is our 2018 Wealth Building Summit recap. This year, we hosted our annual Wealth Building Summit. And this was right across the street from our corporate headquarters in Westlake, Ohio. For those of you who aren't familiar, our corporate headquarters is located in a western suburb of Cleveland, Ohio, again, Westlake, Ohio. And at this summit, we had 2 days of clients teaching other clients how they're operating their self-directed IRAs, investing in a wide array of alternative real estate investments, and unique strategies and techniques. Everything from simple buy and holds to investing in real estate renovations, to partnering multiple IRAs, to investing in lease options, wholesaling, option contracts, using trusts and various other entities with self-directed IRAs to grow wealth tax-free and tax-deferred. So what I planned on doing for this session is highlighting some of these case studies and introducing you to some of the folks that spoke at this conference through their case studies in this short webinar. Now, of course, I can't provide all of the information and education, particularly with the intensity that occurred, but I will do my best to provide the case studies to help you understand how you could potentially look objectively at building a self-directed IRA or self-directed retirement account plan going forward. Before we dive into the details, Equity Trust Company is here to provide education and information. I'm not here to provide tax, legal, or financial advice. Equity Trust Company does not provide tax, legal, or financial advice. So all of our webinars and all of the information that we provide is for educational purposes only. Now I'm going to show you a lot of case studies, clients at Equity Trust that have successfully invested in real estate and been able to grow wealth tax-free and tax-deferred, but that doesn't necessarily predict future results for you. So it's important that you look objectively at all of the potential transactions that you're attempting to make. So that being said, we're going to go ahead and jump into the whole theme of the weekend was about creating more tax advantage dollars. And even higher level than that, the theme was this sort of molecular structure, if you will, to sort of paint the picture metaphorically or using an analogy, using this molecular structure. And attendees, when they saw this image, they immediately began mapping out on pads of paper, or some had spreadsheets, started mapping out what their constellation, if you will, or what their sort of atomic structure was going to be. Some folks were looking at investing just with a Roth IRA. They had their money in a Roth IRA. That's what they wanted to do going forward. Others we're looking at, how can I create more tax-free dollars? How can I create more tax advantage dollars? And some had a traditional IRA and they bolted on a Roth IRA, made contributions, converted funds, etc. Some established Roth IRAs for their children. You'll hear from a case study. Her name is Jan. Her daughter, Brittany, has over $50,000 in a Roth IRA. Some looked at implementing a covered education savings account, health savings account, solo 401k with a Roth component, spousal IRA. So as the weekend progressed, and as we had all these clients talking about different ways in which they've been able to partner multiple IRAs, folks were able to sort of build out what their molecular structure was going to be. So the overarching theme of the entire conference was, what's your chemical makeup, if you will? What is your atomic structure going to be going forward? And then wrapping that all up, it was about speed of implementation. So a lot of the investors that were at this conference, they came into it with the philosophy of, if I can find a deal, I can put a deal together in a self-directed IRA. If I can go out and find a property, I can find a transaction, I can make a transaction occur. I might need to bring in my Roth and my traditional, or maybe my Roth and some of my non-IRA money in a partnership, or maybe I bring in a third party as a joint venture partner. But ultimately, investors learn from other clients and how they could sort of map out and architect these various transactions. And it was about speed of implementation. So it was about learn, do, learn, do, learn, do. So I learn about this account type. I learn how I could potentially grow wealth tax-free or tax-deferred. Now I'm going to implement. Establish the account, fund the account, be off to the races by Monday or Tuesday. So it was a really exciting weekend. Really excited to jump into the content here. In terms of implementing these different retirement plans, it's good to know what the contribution limits are and the types of plans that one could look at. Of course, important that you speak with your tax professional or your CPA as you start to look at these different account types to ensure you qualify, you meet the eligibility requirements, and determine how much you can contribute. But relatively speaking, you have the traditional IRA, tax-deductible IRA, which means when money was going in, you were getting tax deductions. It grows tax-deferred. It's not until 59 and a half or older when you take the money out that you pay taxes. So when you start taking money out after 59 and a half, that's when you have to start paying taxes. If you take money out prior to 59 and a half with an IRA, you have a 10% penalty in addition to the ordinary income taxes. You then have a Roth IRA, 5,500 or 6,500 depending on your age. And with a traditional IRA, I should back up a moment. If you have 401ks or 403bs or other tax deductible accounts, you can roll over those plans into a traditional IRA. If you have existing traditional IRA monies, you could always transfer into those accounts. And then we talked about these different small business retirement plans, SEP IRA, simple IRA, solo 401k. You see the contribution limits there. We're not going to go through these in fine detail. We do have other educational programs to discuss the specifics of these. But relatively speaking, you'll see here, you could potentially, should you have the qualifying earned income, you could potentially contribute larger amounts of money compared to a traditional or Roth IRA. So you're creating more tax advantage dollars. And then there's also a health savings account. If you have a high deductible health care plan, contributing money tax deductible, growing it tax free, take it out, use it for qualified healthcare related expenses, and there's no taxation. And then last but not least, the Coverdell Education Savings Account. So for those that were looking to, at the conference, save for their children's education or their grandchildren's education, they were establishing Coverdell Education Savings Accounts. To start with, I'm going to go back to it for just a second. Very powerful to start with this molecular structure, if you will, again, metaphorically speaking, not technically speaking. And what is that going to look like for you? What types of tax advantaged accounts are you going to implement in order to create more tax advantage dollars? So let me go ahead and fast forward, and I'm just going to jump right into our collage, if you will, of case studies. So first case study is Candice, and she's from Ohio. And Candice and her husband Gary started with us about 6 years ago or so. They've done a number of transactions in their IRAs. Candice had a 401k. She rolled it over to a traditional IRA, started investing in property. Her husband Gary opened a Roth IRA, never had any retirement plans, put $5,000 in the plan, and he now owns a rental property, a duplex in Ohio, cash flowing at about $1,500 a month net, and it has an after repair value of about $135,000. I'll show you that case study in just a moment. So even in a short period of time, he's been able to grow a substantial amount of wealth in this Roth IRA tax-free. So to jump into the first case study, Candice in 2017 bought this property at the Cuyahoga County Sheriff's Sale auction. So this was a purchase where she came to the auction with $5,000 in hand, a check from Equity Trust Company from her self-directed IRA. She bid on the property. She was the winning bidder. She gave the $5,000, and then shortly thereafter, she put in the order through Equity Trust Company, following our process with the direction of investment form and uploading all the documents to send out the remaining cash for the investment. The total all-in purchase was $80,100. The repairs totaled $18,000. To pay for the repairs, Candice used our online portfolio management system. And this system allowed her to simply say, Equity Trust, please make a check payable to XYZ Contracting Company, mailed to this address. She hits submit, we mail out the check. Now, the way Candice processes logistically her transactions is she has the checks mailed to her first, and then she hand delivers those to the contractor. The key here is she's physically not writing the check. It's the Equity Trust IRA. And furthermore, the check is made payable to the contractor, not her personally. So all expenses are paid for from the IRA, and you'll see here in a second all profits flow back into the IRA. I also want to mention this technology platform that Equity Trust offers. So when you have an account with Equity Trust Company, you have access to the online system. That online system allows you to process a real estate transaction from end to end. You can e-sign the documentation necessary. You can document upload all of the supporting documents to close on the purchase. So fully automated, if you will. And then in terms of paying for expenses, you can have checks sent out, or we are also ACH direct deposit capable. So you can have a direct deposit sent out to a contractor as well. In this case, Candice paid for the necessary expenses, directly sending a check to her address, and then she hand delivered that check to the contractors. Total in on the investment, $98,100. Sold it for $144,900. Listed it, and she had an accepted offer within about 24 hours. Closing costs were about $10,000. The title company sent the wire transfer back to the Equity Trust IRA at closing. Net profit recognized in the IRA of $36,800. Here's the important thing for everyone to understand. That $36,800 does not hit her 1040 as ordinary income. That's $36,800 in her traditional IRA. She will not pay taxes on that money until she turns 59 and a half thereafter and decides to start taking money out. At which point in time, when she takes money out, whatever amount she takes out is added to her ordinary income. Treated just like any other traditional IRA. So the important thing is that $36,800, again, is not added to her ordinary income in 2017 as taxable income. So this is a transaction her husband, Gary, I mentioned with the Roth IRA, started with about $5,000. He's been able to significantly grow that in a short period of time. Bought this property at another sheriff sale auction, a similar community, $68,000, put $20,000 worth of work into it. He was able to pay for all of those expenses from the IRA using our online bill pay system. And he's renting it out currently for $900 on one unit, and actually $950 he just reported on the second unit. So the net cash flow, Gary mentioned, is approximated at $1,500. So he's got $1,500 tax-free coming in. Now here's the key with this Roth IRA. And I can go back for a minute to the very beginning to this slide here where you see this Roth IRA. And what we found is many of the folks that were at that conference, they were looking at the Roth IRA because they understood that when they transact business with that Roth IRA, the cash flows tax-free in the Roth IRA when distributions occur after 59 and a half, and assuming the account is seasoned for 5 years, it's tax-free. In the context of Gary here with his Roth IRA, he's got $1,500 net coming in every month that's tax-free. Fast forward to 59 and a half. Thereafter, he can take a distribution every month in the amount of $1,500, and it's never added to his ordinary income tax. It's tax-free to him. That asset, when he sells it, it's tax-free income. So very important to understand our Roth IRA and how it can be utilized within the context of investing in real estate. The after repair value on this property is $135 to $145. So let's say he sells it for $125. He was in it for about $88,000. Let's call it $90 all in. He has about $30,000 in profit potential, and he's got the $1,500 coming in every month before he eventually sells the property. Another property in Maple Heights, Ohio. This is Gary's Roth IRA and his non-IRA money. So here's an interesting transaction. They bought a property for $31,125. They put up $10,375 in just cash, non-IRA money. So Gary's partnering his Roth IRA with his non-IRA money. Now, this has to be done proportionally, and it must most importantly be done properly in order to adhere to the guidelines of the Internal Revenue Code. So what they did is on the contract, they had Equity Trust Company, Custodian, FBO, Gary's Roth IRA, undivided interest 75%, because this Roth IRA put up 75% of the capital needed. And then the name of their LLC, undivided interest 25%. So on title, as tenants and common owners, they had Gary's Roth IRA at 75% and then Gary's LLC at 25%. Everything done proportionally. So $31,125, cash in the deal, $10,375, remaining with the Roth IRA. They put $30,000 worth of work into the property. Now this is important. They put $30,000 worth of work into the property, which means 75% of those repairs had to be paid for by the Roth IRA, 25% their non-IRA money. So logistically, they used their online bill pay system to pay for the 75% with the Roth IRA, and the remaining 25% came from their LLC checking account. So in it for 30, total in the investment 71.5. They sold it for 116, closing costs at about 10,000. Net tax-free profit. So the profit that went back to the Roth IRA was $25,875. The cash profit was $8,625. So the $8,625 becomes taxable because that goes back to Gary himself or his LLC, $25,875 into the Roth IRA tax-free. So moving on, next case study is Brian from Tennessee, and Brian unfortunately could not make it to the event. But Brian recently did a webinar with us, and he was named the 2017 Investor of the Year. So we did showcase his case study. So Brian was able to make $130,000 tax-free in 2017 between 3 of his children's covered education savings accounts and then 2 of his Roth IRAs, one for him and one for his spouse. Deal number 1, Brian found a vacant lot for $8,000. He bought the property as tenants and common owners between 3 of his children's CISA accounts, $2,000 from CISA 1, $2,000 from CISA 2, and $4,000 from CISA 3. So one of the CISA accounts with $4,000 in had 50% equity, therefore, as an undivided interest owner, had 50% on the contract. And then 25% for CISA number 2, 25% for CISA number 3, all in $8,000. It was in a up-and-coming area. There was a mobile home park that was being developed, and so the surrounding areas were appreciating in value significantly. And so he sold it, it says 60 days later, I believe after it was 60 days, he had a contract, so it was about 90 days. They closed on the property, $60,000, about a $52,000 net tax-free profit in the 3 covered education savings accounts. So let's call it $50,000 in profit. 50% of that goes to CISA number 1. 50% of $50,000 is about $25,000. So $25,000 plus the initial principal of $4,000, it's about $30,000 that he was left in that covered education savings account. That money can be distributed tax-free to pay for K through 12 education as well as higher education. And Brian said on the webinar, I believe he said another deal or 2, and he'll be able to pay for that children's entire education. And the other children, they split the remaining $25,000. So you're looking at, about $17,500 into each one of those respective accounts. So then fast forward, deal number 2, he found this property here that I'm circling. It was 2 lots. One of the lots had a property that needed to be knocked down. And so he got the property under contract. And at one time, this property was actually 3 lots. But then it was converted to 2 lots. Property was on the second lot. He knew that he could get 3 lots. So he could re-subdivide it, if you will, into 3 lots. So he bought it with 5 accounts, 3 CISAs, and then a Roth for him and a Roth for his wife. So they all partnered on the deal, all as tenants and common owners, $120,000 purchase. He subdivided into 3 lots, sold it to a developer. That developer built these townhomes, and he sold it to the developer for $200,000. So he made about an $80,000 profit. So between the two transactions, he made about $130,000. So that leads us to Jan from Missouri. And here's a picture of Jan and her husband Gary, who was in attendance, and their daughter Brittany. Brittany unfortunately couldn't make it. As Jan had mentioned, she's still in school at this time out on the West Coast. And she wasn't able to make it, but we actually had a few years back Brittany at one of our conferences in Orlando, and she actually spoke on the panel. So she talked about how she was able to, with the help of her parents, grow her Roth IRA to a substantial amount in a short period of time. She now has, as Jan reported this past weekend, over $50,000 in her Roth IRA. And she's getting close to the age of 21. Again, she's still in school. She's going to start her junior year here shortly. So Jan and her husband, Gary, and their daughter, Brittany, are from Missouri. And they bought their first house in 1985. She considers herself now a lifestyle entrepreneur. They've been self-directing their Roth IRAs for 8 years or so. They initially converted their traditional IRAs to a self-directed Roth IRA with Equity Trust Company as their custodian. So Gary and Jan had 401ks. They rolled over to traditional IRAs, and they said, okay, the crop's about 3 feet big. We don't want to pay it when it's 10 feet and 16 rows across, so we're going to go ahead and get the taxes out of the way now. So they converted their traditional IRAs to their Roth IRAs, and then they also established a Roth IRA for their daughter. They started with about $187,000 in Roth IRA wealth. They now have $1.638 million, and again, that's 2012 to 2018. So they went from 187 to 1.638. They've used a variety of different strategies, renovation. They've done buy, fix, and sells. They've bought and hold. They have a rental now in one of their IRAs, lease options. They've done a lot of hard money lending and private lending. So a number of different strategies used here. This property here, this is a buy, fix, and sell, Berry Hill Drive in Missouri. October 5th, 2016, they bought the property for $299. October 17, 2016 to April 2017, they made 7 payments to their general contractor using the online bill pay system. June 20th, 2017, they sold the renovated property for $529,000. And the IRAs received $54,550 after all expenses. So this was in Jan's IRA. Her IRA made $54,550 tax-free. The duration of the investment was about 8.5 months. So again, Jan simply processed the transaction using our online technology platform from end to end. The 7 payments to the contractor were made using the online bill pay system, requesting the checks sent to Jan. Jan gives them to the contractor. And then when they sell the property, they have a wire transfer go back into her IRA, recognizing realized net tax-free profit of $54,550. Here's some after pictures of the house. We're just going to scan through these quickly. This is her, as she calls it, lower level, never using the B word, that being basement, fully furnished. And again, going back here, sold the property for $529, $54,550 on the tax-free profits. So they do an incredible job. As she says, their general contractor essentially takes down all of takes down everything pretty much to the studs and builds it back up from the ground up. Another property here, what Jan did in this instance is she got a property under contract and sold it to another investor in her marketplace. So this was a wholesale transaction, if you will. May 30th, 2018, bought the property for $370,000 in their IRAs, 70% with her Roth IRA and 30% with her husband Gary's IRA. And then they sold it for $419 to an investor, split the profits between their two IRAs, 70%, 30%, and made $46,557 tax-free in less than 2 months. Here's a buy and hold in Missouri as well. Bought it for $171,500 in Jan's IRA. They began the renovations, $30,000 estimated repairs, 6 weeks, and renting out for $2,200 a month. Also potentially looking at a lease option strategy as an exit strategy for $350,000. So now if it rents for $2,200, she'll have $2,200 going back into the Roth IRA every month, tax-free. The last thing I'll mention about Jan, which is really interesting, is on a couple of the transactions, she created a joint venture with her general contractor. So at one point, she didn't have enough money in all 3 IRAs, her IRA, her husband's IRA, and Brittany's IRA, in order to buy, renovate, and sell the property. She didn't have enough money for the material costs and the labor. So what she did is she created a joint venture with her general contractor. Their IRAs bought the property. The IRAs took care of the acquisition and the carrying costs and some of the repairs. And then the contractor paid for much of the labor and much of the materials. And they created a joint venture. So when they sold the property, a percentage of the profits went to the general contractor, percentage of the profits went to their IRAs. So as she said, that gave the general contractors the added incentive to get the project done faster because they knew they wouldn't get paid until settlement. The reason why I bring that up is because it's a great way to look at it from the perspective of investors who might not have enough money in one IRA or multiple IRAs. So consider this. Let's say someone had a property for, let's call it all-in purchase and rehab, $50,000, and they're going to sell it for $100,000, make we'll call it after closing, $40,000 in net profit. So they put up, let's say, $5,000 with their Roth IRA, and then they have a third-party non-disqualified person. That's key. Third-party non-disqualified person. Not their money, not a family member's money, but a third-party non-disqualified person. That third-party non-disqualified person puts up 45 of the 50,000 needed. So they go into and enter into a contract. They create maybe a joint venture agreement or an LLC operating agreement, and they bring the 2 investors together. Ultimately, this is where an attorney would get involved in order to paper the transaction. This wouldn't involve Equity Trust. We're the passive custodian. You'd want to work with an attorney for this part of the transaction. But following along the hypothetical here, $50,000 all-in purchase and rehab, $5,000 with, let's call it Joe's Roth IRA, $45,000 with an investor friend of his IRA money or non-IRA money. They sell it for $100,000, but per their joint venture agreement, they state that the profits are split 50-50. They're non-disqualified persons. So 50-50 profit split, 50% of $40,000 is $20,000 going back into the $5,000 Roth IRA. So now you have $20,000 in profit, $5,000 original principal. You got $25,000 seated in the Roth IRA. The other $20,000 goes back to the other investor. So the other investor put $45,000 in as a money partner, made $20,000. They're happy. And then the Roth IRA investor put $5,000 in and made $20,000, all tax-free. So a joint venture can be another way for investors who don't have enough money in their IRA to look at doing deals. So the key here is find a transaction and then make a transaction. And that leads me to the last part of this, which is Jan's daughter, Gary and Jan's daughter, Brittany, I mentioned before. They did 5 renovation projects with her Roth IRA. One of the first deals they did, she only had 3% equity in the deal because her IRA could only pay for 3% of the initial purchase and 3% of the expenses. So on those transactions, you'll see the formatting equity trust company, custodian FBO, their account number, IRA, 60% undivided interest, and then the next IRA account number, undivided interest, 33%, and then Brittany's IRA was 7%. Great story there. Important to understand as you're going through all of these different types of transactions, what the next steps are. So one of the themes throughout the conference, as I mentioned before, was speed of implementation. And one of the themes throughout all of these investors that presented these case studies was they learned at a seminar or conference or on their own, and then they immediately implemented. So what I want to do is map out for you what the steps are involved to get started and really start executing on these types of transactions. So the first step is select the account types to open and fund. Now, I understand this webinar, we have folks that are brand new, we have folks that have multiple accounts, are maybe looking to add on a second or third account. So at the end of the day, determine what is your atomic structure or molecular design going to be. Figure out which types of accounts you need to set up and fund, and if you need to, work with a CPA or tax professional to determine that. The second step, of course, is fund the account. That could be done through a contribution, a possible rollover from a 401k, 403b, TSP, other type of tax qualified account, or possibly a transfer from an existing IRA. That might be a partial transfer or a full transfer. We can help you with that process to a certain extent. So if you have questions about how do I fill out the application, how do I get the transfer form going, what do I need to say to my company to start the rollover process, we can provide some guidance on those steps. Again, we can't be your tax advisor, your legal professional, but we can certainly give you the step-by-step process. And then, of course, the third step is direct your funds for your investments. So determine where you want to invest and then direct the funds for those investments. To do this, we have this online technology platform that we talked about, which can allow you to start your investment process online. And I would encourage folks to use our My Equity platform for that. So I mentioned the atomic structure, if you will, creating more tax advantage dollars, the theme. So if you haven't already, take a screenshot of this, make sure you draw this out if needed, figure out what your molecular makeup, if you will, needs to be. So that being said, as we conclude here, I want to make sure that everyone on this webinar has the opportunity to take action on the theme that we had talked about in creating your own atomic structure, if you will, or your own assembly of various account types. And at the conference, we had a number of individuals that took advantage of a one-on-one consultation with one of our account representatives. And that's a debrief, if you will, of what they've learned and how they can implement what they learned. Speed of implementation, learn, do. These representatives aren't providing tax or legal advice. Again, we're a passive custodian, but they're providing some information on how they can establish the various account types that they would qualify for. So again, not a legal review, not financial advice, but rather providing some information and guidance on how to set all of that up for them. So that being said, I want to make sure that everybody on this call can take advantage of a one-on-one consultation as well. So if you're interested in maybe introducing a Roth IRA to your portfolio mix, if you're looking to establish an HSA, health savings account, or a covered education savings account for your children or grandchildren, we can walk through the process and provide the documentation associated with those arrangements. So that being said, for anyone who is interested, what I would encourage you to do is email us at webinars@trustetc.com. And in the subject line, please put consultation. Again, that's webinars@trustetc.com. In the subject line, place consultation. Or you can call us direct at 888-382-4727. Again, that's 888-382-4727. Ask for an account open representative, and we can assist with that process. Again, webinars@trustetc.com. Subject line consultation. We hope to hear from many of you and hear feedback from many of you. I hope you enjoyed the webinar, and we look forward to seeing you on the next call.